Today on the FinTalk channel, we're talking about Alphabet Inc. GUGL. Imagine getting handed a $3.5 billion speeding ticket, paying it entirely in cash, and then watching it make absolute no dent in your day-to-day lifestyle.
I mean, it sounds impossible.
Right. But that is the actual financial reality of Alphabet right now. We're looking at their massive Form 10Q filed for the quarter ending September 30th, 2025.
And it is a beast of a document.
Oh, totally. This document is attempting to capture the economics of the world's primary information gateway, alongside, bleeding-edge venture capital bets, global cloud infrastructure, and hardware manufacturing.
Yeah, it's not just a search engine anymore, not by a long shot.
Exactly. So our mission today is to decode these financials for you, the investor. We need to figure out how a company of this sheer, staggering size balances its legacy cash cows, its highly aggressive AI spending, massive regulatory headwinds, and somehow still returns billions in capital to shareholders. Okay, let's unpack this.
Yeah, the numbers we are dealing with here really, they just test the limits of human comprehension, I think. Financial gravity just acts differently at this scale.
It really does. So where do we even start with the top line?
Well, for Q3 2025, total revenues hit $102.3 billion.
Wow.
Yeah, that is a 16% year-over-year increase. And net income reached $34.9 billion, which is a 33% jump.
33%. That's just wild.
Right, because adding 16% growth to a baseline that is already, north of $88 billion in a single quarter, it defies the law of large numbers.
Yeah, you just don't see that.
No, it's an acceleration you normally only see in mid-cap growth stage companies, not a multi-trillion-dollar behemoth.
Well, the breakdown of that revenue is where we really see the muscle, I think.
Yeah.
Google Search and other brought in $56.5 billion, up from $49.3 billion.
Unbelievable.
And YouTube ads generated $10.2 billion. But there is a paradox in the metrics underneath those dollars that I want to ask you about.
Oh, the clicks and pricing.
Exactly. So paid clicks grew by 7%, and cost per click, the CPC, also grew by 7%.
Which is highly unusual.
Right, because economics one says that in a typical marketplace, if you dramatically increase the supply of something like flooding the market with 7% more ad inventory, the price per unit should compress.
Right, or at least stay flat.
Yeah. So why are they both going up?
What's fascinating here is the underlying mechanism of that growth. Alphabet basically delivered a 7% increase in volume and a 7% increase in price simultaneously.
Which is the dream scenario for any business.
It really is. Advertisers are buying more ad inventory than ever before, and they are willingly paying a premium for it. To understand how that defies basic supply and demand, well, we have to look at the AI models driving their ad targeting.
So the product they're selling to the advertiser has fundamentally changed.
Precisely. 10 years ago, an advertiser was paying for a digital billboard. They just hoped the right person clicked it.
Right, spray and pray.
Exactly. But today, Alphabet's generative AI models are predicting user intent with such terrifying accuracy that a single click is it's drastically more likely to result in an actual finalized sale.
So the conversion rate is much higher?
Yes. Advertisers don't care if the cost per click goes up 7% if their actual cost to acquire a paying customer goes down. Alphabet is just capturing the value of that increased efficiency.
Okay, I get it. It's like operating a toll bridge where the physical traffic of cars is increasing by the millions, and you just successfully raise the toll price without a single driver turning around to find another route.
Because your bridge is the only one that guarantees they won't hit traffic.
Exactly. But I'm looking at their expenses, specifically the traffic acquisition costs, or TAC. The TAC rate dropped to 20.1%.
Which is a big deal for their margins.
Right, but before we celebrate that as a massive win, tell me what TAC actually is mechanically, just so we're all on the same page.
Sure. TAC is essentially the rent Alphabet pays for digital real estate.
Okay.
It's the billions of dollars they pay to partners like Apple or Mozilla to be the default search engine on your phone's browser.
Right, the Safari deal.
Exactly. It also includes the cut they share with third-party websites that display Google network ads. And the filing specifies that the overall tax rate dropped primarily due to a revenue mix shift.
Meaning the different departments inside Alphabet are growing at different speeds, changing the overall blended average.
You nailed it. Google Network Properties. So those ads shown on third-party websites, they structurally require a much higher tax rate.
Because Google has to hand over a massive cut to the actual website owner.
Right. But Google search revenues, which are on their own properties where they keep almost all the money, those surged this quarter. Meanwhile, network revenues actually declined slightly year over year, dropping from $7.5 billion down to $7.3 billion.
Oh, I see.
Yeah, so the highest margin part of the business vastly outgrew the lower margin part.
So Alphabet is just milking this owned and operated search cash cow for all it's worth.
They absolutely are.
But they have to, right? Because if they don't extract every single penny of efficiency from search, they cannot afford the absolute bloodbath happening over in Enterprise Cloud.
That is a great transition.
Let's pivot to Google Cloud. Revenues jumped to $15.1 billion, up from $11.3 billion a year prior.
Very strong top line.
Yeah, but the operating income is the real headline to me. It almost doubled, hitting $3.59 billion.
And that operating margin expansion is really the holy grail for a cloud infrastructure business.
Why is that?
Well, for years, Google Cloud was heavily criticized by Wall Street because it was bleeding money. It was basically a loss leader.
Right.
They were frantically building data centers and laying undersea cables just to capture market share from AWS and Microsoft Azure.
Which are not cheap.
No, those are massive fixed costs. I mean, the physical building, the power grid connections, the cooling systems, they cost the exact same whether you have 10 corporate clients or 10,000 corporate clients.
Right, but once those fixed costs are paid for by that first wave of customers, the math flips.
And we are seeing the beautiful physics of software operating leverage play out right now.
It's amazing to watch.
Yeah, as revenues scale up to that $15 billion mark, those fixed costs are fully covered. Every incremental dollar of revenue from a new client starts falling almost directly to the bottom line.
So doubling operating income on a 33% revenue increase is a textbook example of that leverage.
Exactly. Cloud is no longer a subsidy. It is a standalone profit powerhouse.
And they're taking those massive profits and going shopping.
They certainly are.
Here's where it gets really interesting. The 10Q highlights a blockbuster announcement. Alphabet entered a definitive agreement to acquire the cloud security platform Wiz for $32 billion in cash.
A historic acquisition.
Now, I have to push back on this. $32 billion is a staggering amount of cash. Are they actually buying Wiz for the underlying technology, or are they just forcefully buying market share to close the gap with Microsoft and Amazon in the enterprise space?
Honestly, it is heavily weighted towards strategic positioning and market share.
I knew it.
Yeah. When you are selling cloud contracts to the Fortune 500 or a major bank or the Department of Defense, you aren't just selling server space anymore. You are selling a digital fortress.
Okay, that makes sense.
The filing notes Wiz's expertise in zero-trust architecture, and that is the primary bottleneck keeping legacy corporations from fully moving to the cloud.
Wait, stop right there. Zero trust architecture sounds like a slick marketing buzzword.
It does.
What does that actually mean mechanically for a company like, I don't know, Delta Airlines or Ford trying to move their data to Google Cloud?
Sure. Think of a traditional corporate network like a castle with a moat. You have a firewall at the perimeter. Once an employee or a vendor crosses the moat and gets inside the castle walls, they are trusted. They can walk into almost any room.
Which sounds risky.
It is, because the problem is, if a hacker steals an employee's password, they cross the moat and they basically have the run of the place.
Oh, right.
So zero-trust architecture removes the concept of the moat entirely. It assumes the network is already compromised.
Wow, okay.
Mechanically, it means every single application, every single database, and every single room in the castle has its own heavily armed bouncer checking your ID continuously every single time you try to open a door, regardless of whether you are already inside the building.
So if you can't guarantee that level of ironclad, room-by-room security, you don't even get invited to the pitch meeting for these massive corporate contracts.
Exactly. Wiz has proven itself to be highly effective at managing that exact type of security across complex multi-cloud environments.
Which Google desperately needs.
Right. And by paying $32 billion in pure cash, which, by the way, means zero stock dilution for current Alphabet shareholders, Alphabet is signaling to the largest enterprises in the world that Google Cloud is the premier destination for secure infrastructure.
So they are buying the technology, yes, but they are really buying the trust of Wiz's massive existing C-suite client base.
You hit the nail on the head.
But Wiz is just the software layer, right? That software has to live somewhere in the physical world.
Oh boy, yes it does.
Let's talk about the hardware reality behind the cloud and AI, because the cash going out the door here is terrifying. Capital expenditures, so CapEx, were $24.0 billion for Q3 2025 alone.
Just massive.
For the first 9 months of the year, they've spent $63.5 billion. And the filing explicitly states they expect 2026 CapEx to significantly increase relative to 2025 to support AI products and services.
If we connect this to the bigger picture, this is the single most critical dynamic for long-term investors to monitor.
I agree completely.
We are witnessing an infrastructure build-out that rivals the laying of the global railroad system, but it's happening almost instantaneously.
Wait, $24 billion in physical stuff in 1 quarter.
Yeah,
That is literally the GDP of a small country.
it really is.
We aren't talking about coding an app here. We are talking about acquiring thousands of acres of land, building specialized power substations, installing industrial liquid cooling systems, and, fighting bidding wars for tens of thousands of specialized NVIDIA chips.
The physical footprint is staggering.
So as an investor, how do we know if this is a calculated demand-driven infrastructure build-out, or if Alphabet is just panic buying servers and lighting money on fire so they don't look like they are losing the AI arms race to Microsoft and Meta?
Well, that is the defining anxiety of the entire tech sector right now.
Right.
Management will always insist it's calculated, that it's driven by user demand and the sheer computational intensity of training these generative AI models.
But the numbers don't lie?
Exactly. The accounting realities are going to force the issue, and soon. You have to look at the depreciation line in the 10Q. Depreciation on property and equipment hit $15.1 billion for the first 9 months of the year.
Okay, let's break that down for the listener.
Yeah.
Because under generally accepted accounting principles or GAAP rules, that $24 billion CapEx doesn't immediately crush your net income on the day you spend it, right?
Correct. When Alphabet buys $1 billion worth of specialized AI servers, that $1 billion leaves their checking account immediately.
Cash is gone.
Yes. But on the income statement, GAAP rules dictate that they don't take $1 billion expense that day. They have to match the expense to the revenue it generates over time.
So they depreciate it.
They do. They spread that cost out over the useful life of the server, which in tech hardware might be 4 or 5 years.
So they record a $200 million expense every year for 5 years instead of $1 billion today.
Yes. So that $15.1 billion in depreciation they just reported, that is the ghost of CapEx past coming back to reduce today's profits.
That is a great way to put it.
Because they were currently spending $24 billion a quarter, that depreciation number is going to balloon into an absolute monster in 2026 and 2027.
Absolutely.
These massive physical infrastructure bets will severely drag on future earnings unless the actual monetization of AI, like the new subscriptions, the higher ad rates generated by those specific servers, unless that scales up just as fast to offset the rising depreciation costs.
So they are essentially putting themselves on a financial treadmill where they have to run faster and faster just to maintain the profit margins they have today.
That's exactly it.
If the AI revenue revolution is delayed by even a year or two, that depreciation is going to eat their income statement alive.
That is the multi-billion-dollar risk every tech investor is taking right now. Alphabet is betting that the productivity gains and entirely new product categories unlocked by AI will generate enough high-margin revenue to easily clear that rising hurdle.
But the hurdle is getting taller every single quarter.
It is growing exponentially.
Which brings up a psychological challenge for management. How do you stop your shareholders from revolting while you force them onto this terrifying CapEx treadmill?
You have to distract them.
Exactly. You have to offer them some massive immediate gratification. And you have to do it even when global regulators are actively trying to kneecap your business model.
The regulatory side is fascinating.
Let's look at the speed bumps. On September 5th, 2025, the European Commission slapped Google with a $3.5 billion fine for infringing competition laws.
Ouch.
Yeah, that was accrued immediately in Q3 under general and administrative expenses.
And you have to remember, a $3.5 billion hit to the bottom line in a single quarter would be a catastrophic, company-altering event for 99% of publicly traded businesses.
Right. People would be losing their jobs. The stock would crater.
Exactly. But for Alphabet, it is absorbed with barely a ripple in their operational cadence.
So what does this all mean? To me, this brings us right back to our opening thought. It's like getting a massive speeding ticket while driving a bank vault.
Yeah, the bank vault analogy is perfect.
The driver is frustrated, the lawyers are annoyed, but it absolutely does not stop the trip. And it certainly doesn't empty the vault.
Not even close.
Because in that exact same quarter where they ate a $3.5 billion fine, Alphabet casually repurchased $11.6 billion in their own Class A and Class C shares.
Just unbelievable cash generation.
And they increased their dividend by 5% to 21 cents per share.
It's a profound flex of balance sheet strength. I mean, think about it. They are funding a $24 billion physical hardware build-out, digesting a massive European regulatory fine, preparing to write a $32 billion cash check for Wiz, and they are still generating enough free cash flow to buy back $11 billion of their own stock to keep shareholders happy.
It's wild when you list it all out like that.
It just demonstrates the unbelievable cash generation of that core search and YouTube advertising engine we discussed at the top.
But hold on, I'm looking closely at the bottom line here, and I think we need to issue a warning to the listener.
About the net income.
Yes, that $34.9 billion in net income looks incredible. But there's a massive distortion hidden further down the page in the other income and expense line, or OINE.
Yes.
The filing shows OINE was a massive $12.8 billion in Q3. And the notes explicitly state that this was heavily driven by $10.7 billion in unrealized gains on non-marketable equity securities.
That is a crucial detail.
If it's unrealized, meaning they haven't actually made the cash, why is it juicing their net income? I am genuinely confused by how this works.
You are right to pause on that because it is a vital gap accounting quirk that dramatically skews tech earnings.
Okay, walk me through it.
So Alphabet holds massive equity stakes in many private, unlisted startups. These are the non-marketable equity securities. Under current accounting rules, if the implied value of those startups goes up, so say one of those AI startups raises a new round of funding at a higher valuation, Alphabet has to record that theoretical increase in value as income on their income statement today.
Even though they haven't sold a single share.
Exactly, even without a liquidity event.
That is bizarre. It's like a homeowner looking at their house on Zillow. The algorithm says their house went up in value by $100,000 this year. They feel richer, and their net worth is technically higher on paper, but they can't go to the grocery store and buy milk with that Zillow estimate.
That is the perfect analogy.
They don't have the cash unless they actually sell the house.
It is pure paper wealth. So of that massive $34.9 billion in total net income Alphabet reported, nearly a third of it, $10.7 billion, is just the mark-to-market upward valuation of their private startup portfolio. It's not cash generated from selling search ads or cloud contracts. If the venture capital market crashes next quarter and those startup valuations drop, Alphabet will have to write those values down.
Which will artificially crush their net income.
Exactly, even if their core advertising business is having a record-breaking quarter.
That perfectly highlights why operating income, which came in at a very healthy $31.2 billion, is often the much truer metrics for investors.
It really is.
Operating income strips out the Zillow estimates of their startup portfolio and reflects the actual cash-generating day-to-day operations of the core business.
And that core business is performing at a historic level, funding everything else we just talked about.
Well, we have covered a staggering amount of ground today. Let's do a quick recap of the narrative we've pulled from this 10Q.
Sounds good.
Alphabet remains an absolute cash-generating machine. The core search and YouTube ad business is not just growing AI, is giving them increased pricing power to raise costs on advertisers while delivering better results.
A total win-win for them.
Exactly. And Google Cloud has officially crossed the Rubicon from a strategic loss leader into a highly profitable standalone growth driver, which they are aggressively reinforcing by buying the C-suite trust of Wiz for $32 billion in cash.
Which is huge.
And this massive blended cash flow allows them to fund eye-watering physical AI infrastructure builds, whether multi-billion-dollar European fines like a minor nuisance, and still buy back billions in stock. It was a masterclass in scale.
It really is a masterclass. But, looking through all these schedules and notes, there is a fascinating undercurrent hiding beneath the massive server farms and ad revenue.
What was that?
This raises an important question.
Yeah.
We just talked about that $10.7 billion in unrealized gains on non-marketable equity securities in just a single quarter.
Right, the paper wolf.
Well, if you look closely at their balance sheet, Alphabet is quietly operating one of the most successful venture capital and investment funds in the world, embedded right inside a tech conglomerate.
Oh, wow. It's an entire parallel business hiding in plain sight.
It really is. They are taking the cash generated by your daily web searches and aggressively seeding the next generation of global innovation across hundreds of private startups.
That's incredible to think about.
So the provocative thought for the listener to take away and mull over is this. Everyone on Wall Street is laser focused on the search algorithms and the physical AI data centers. But is Alphabet's true long-term future value actually hiding in its massive, opaque investment portfolio of unlisted startups?
Are we looking at a traditional tech company? Or are they essentially becoming an index fund of the future economy,
Yeah.
just subsidized by a search engine?
That is exactly the question.
That is a phenomenal question that completely changes the lens through which you value the stock. Well, to you, our listener, thank you for joining us for this deep dive on the FinTalk channel. We encourage you to keep exploring these numbers, read the filings, and remember that when you look at a modern tech giant, you cannot expect traditional engineering precision.
No, you definitely cannot.
The accounting rules create distortions. The physical infrastructure costs are staggering, and the financial landscape is incredibly complex. But if you look closely enough at the mechanics of how the machine actually works, the true picture always reveals itself. Until next time.